data next. This is a chart from First Trust and Bloomberg showing the S&P 500's performance during every bull and bear market going back to World War II. The x-axis is time and the y-axis is total returns. It turns out that bull markets last an average of 4.3 years, while bear markets last 11 months. And the average return during a bull market is 150%, while bear markets lose roughly 32% on average. That means bull markets last 4.5 times longer than bear markets and return 3 times more than bear markets drop. This is why millionaires get made during stock market crashes. They're really opportunities to buy the best stocks at the biggest discounts. That's also why I focus on long-term investing. It takes years for markets to hit the top and recover from their bottoms. And to understand that, let's look at another study that splits bear markets into 2 parts, their declines and their recoveries. In 1956, the S&P 500 went down 21% over 15 months, and then took another 11 months to recover from the bottom. Compare that to the start of the pandemic, where the market dropped 34% in just 1 month, and it also only took 5 months to recover. There's an important lesson in this study that I think will make millionaires as well. The average bear market takes around 13 months to bottom, and another 24 months to recover. And even the shortest bear market lasts months, not minutes. That means there's always plenty of time to plan, build cash, and prepare to be greedy when others are being fearful. That's how real money gets made in the stock market. But how do we actually know when to be fearful and when to be greedy? Let me show you that next. Before I even check my favorite stocks, I always check CNN's Fear and Greed Index, which is currently showing extreme fear. This is one of the lowest ratings I've ever seen for this index. And if we look at a 1-year timeline, the market is the most fearful it's been in the last year, which is useful info for anyone who wants to be greedy when others are being fearful. The reason I check the Fear and Greed Index first is because it's an average of 7 very useful market indicators, like stock price momentum, strength and breadth, the current ratio of puts to call options, and market volatility, as well as the relative demand between stocks and bonds. So I get a lot of high-level market information all on one page. 2 of the metrics that I use the most are market momentum and volatility. Market momentum compares the S&P 500 to its 125-day moving average. There are around 250 trading days a year, so this is really the S&P's 6-month moving average, and the separation between the current price and its 6-month average tells you roughly how much momentum the market has and in which direction. So right now there's a lot of downward pressure on the market from these tariffs. So my plan is to keep building cash until that pressure starts to reverse. The price doesn't need to get back above the 6-month moving average, but I try not to dollar cost average in too heavy until I'm confident that I'm not working against the rest of the market, which means the price should be trending upwards. The VIX is the S&P 500's volatility index, which measures how much